Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we've actually got a special guest. His name is Joe Hegener. He is the founder and CIO of Astrazoa Management, and he's going to tell you a little bit more about himself. But the reason we had him on today's episode is to speak into the falling interest rates and the environment that we're in around that, and what type of steps and mitigation you should be considering in today's environment. And so that's why Joe is on the show today. So Joe, welcome to the show.
Thanks very much. Yeah, thanks for having me.
Yeah. So we met Joe almost a month ago or so ago down in Huntington Beach. And Alex met him more than me. So Alex dove into some analytic stuff when it came to fixed income and interest rates, which is why we wanted Joe on the show.
I mean, anytime I get to talk to the chief investment officer of a investment company, that's my jam.
Yeah. So, before we dive into this, we told Joe about our routine around talking about what beers we're drinking. So, Joe, we're going to start with you since you're the guest. What beer do you got on tap for us today?
I went down. There's a great craft market down the street from my office here. I went down and I grabbed a West Coast IPA by Pure Project out of San Diego. I went to high school in San Diego, and San Diego has a great craft beer scene. So I had to give that a try. I actually haven't tried this yet, so I'm looking forward to that.
That's awesome. We tend to have a ton of IPAs on the show, so you are continuing with the IPA theme that we tend to have. So being in the Northwest, we have quite a bit of IPAs. So awesome. Alex, what are you drinking?
I'm going to be a contrarian today. I'm drinking a wit beer. This is from one of our favorite breweries, Black Raven, right up here in Redmond, Washington. So it clocks in at about 5%. And it's just for anybody who isn't or hasn't been exposed to wit beers before, go check out some wits. It's a delicious beer. It's nice and clean. It's great for a crisp fall day like today.
And I'm also going to be a contrarian. I was at Drew Brew yesterday, Alex, on our way back through, and it's Oktoberfest. So I went with the Kolsch German style beer, given that it's Oktoberfest area. So I haven't had it actually yet. So Alex, what have you had that wit beer before?
I have this. It's one of my favorite wits. It's right up there with some stuff out of Colorado. But yeah, I'm a big fan of Black Raven. 9 out of 10 for me. This is one of my go-tos.
Yeah, the Kolsch at Drew Brew is actually pretty solid. I'm not the biggest Kolsch fan, but I'm going to give this one a good solid 8 out of 10. So Joe, we forgot to tell you, we do ratings of our beers on the show. We're very connoisseurish around our beer, and I'm being sarcastic there.
Wow.
So of the IPAs that you've drank, Joe, how do you rank that out of 10 bottle caps?
Oh man, that's gotta be an 8 or a 9. That was really, really good.
Oh, he's going 8 or 9 out of San Diego. Man.
It's got a good
there we go. Awesome.
They do.
Well, let's dive into today's topic, though. Before we dive, though, Joe, give everyone a bit of background about yourself.
Sure. Yeah. So like I said, I went to high school in San Diego. I actually played lacrosse at the University of Pennsylvania after that. Graduated with a degree in economics. Took my first job out of college at BlackRock, and I was in New York City. It's actually in the risk solutions and analytics group, portfolio analytics, multi-asset analytics. Internally facing, worked with the Financial Markets Advisory Group, which is kind of like the financial market SWAT team, if you will. They're the guys that get called in to unwind the SVB blow up. They were the guys to unwind Maiden Lane post Great Financial Crisis. Right around when I was first started working there, they got hired by the Central Bank of Greece and the European Central Bank during the European debt crisis. And that was a fascinating time. And then also provided kind of analytical investment and outsourced investment support for the chief risk officer and chief investment officers of reinsurance companies, standard insurance businesses, pension funds, endowments, central banks, things along those lines. And then towards the end of my time there, I focused mostly internally, developed a little bit of a niche for myself in modeling more esoteric, idiosyncratic type exposures, risk exposures, vis-a-vis alternatives. And then I left that job to go work at PIMCO in Newport Beach for a few years. And that was a more traditional direct fixed income portfolio management type role. I worked for a guy or a gentleman named Jerome Schneider. Specifically wanted to work for Jerome because he was the Morningstar Portfolio Manager of the Year in 2015, I believe, which is the last time the Fed tried to raise rates. And he did a great job of, managing a very, very generalist approach, managing the book, and got a lot of accolades for that. I left PIMCO, in 2019 to launch a hedge fund. I launched that hedge fund with some partners. I ran that for about 2 years, and after 2 years of some excellent returns, I spun out of that, moved to Scottsdale, Arizona, where my wife was born and raised, my 2 kids here, and set up Astrazoa Management. And it's a fully independent shop. It's owned by me and the employees that we have at the firm, and we manage private funds, hedge fund strategies, as well as we sub-advise a liquid alternative credit ETF.
Very cool.
So you've been.
I'm
Go ahead,
super
Alex.
curious at some point, like over beers. I'm really curious to hear like how all of the Greek debt crisis like went down and how you guys unwound some of that. But
I'll tell you a quick anecdote actually, which is kind of a funny story. So the very first thing that the FMA guys did was they're cracking open all the Greek government financials effectively. And the biggest thing, the most obvious thing everybody noticed was that Greek citizens on average really don't pay their taxes. It's just not culturally, it's just not a thing. And it was something ridiculous. It was like 25% of what was actually owed was being collected. And so
holy cow.
BlackRock didn't really know how to get Greek citizens to pay their taxes. So they hired a local Greek consulting firm to try to figure out a way to, to nudge Greek citizens to pay or contribute towards the cause or whatever it might be, right? And I swear this is true. Their best idea was, okay, we're going to get in a helicopter and we're going to fly over Athens. And everybody with a swimming pool probably isn't paying taxes. And they would go and knock on the door and audit them. And sure enough, they weren't paying their taxes. And after about a month or 2 of doing this, there was a thriving black market in the streets of Athens where people were buying and selling camouflage canopies to put over their swimming pools. Just to give you an idea of how different, a reality it is over there.
Wow.
Yeah, there's all sorts of crazy things. I mean, there's, just same as in Italy, there are bank loans that are collateralized by wheels of cheese. Like it's a very different financial market environment over there. And, one of the reasons why I actually, I have a bias against kind of peripheral Europe because of that experience, because the whole point of zero interest rate policy during that time and for the next 10 years was to buy breathing room for these otherwise insolvent countries to get the house in order, right? To enact reform and get the balance sheet back together. Well, that never really happened, right? Everything that you look at from productivity levels, demographics, debt to GDP ratios, everything's arguably worse now than it was in 2012 and 2013. It just didn't matter because the cost of debt was zero. But now, for the first time in a long time, the cost of debt isn't zero anymore. It's 400 basis points higher or so. And Germany's not coming to the rescue this time with a bailout package. There's a lot of, kind of populism that's been bubbling in both northern and peripheral Europe. That's pretty anti-EU. And that, in my opinion, is one of the most underappreciated risks in financial markets is peripheral Eurozone insolvency, a European debt crisis 2.0. From a probability weighted standpoint versus what's priced into the market, I think that's the most underappreciated risk. One of the most, at least.
I have a lot of questions for you, but that's a whole nother episode, I think.
Absolutely is.
So you brought up zero interest rates, right? Like when we look at kind of transferring this or transitioning this conversation to the U.S. and where we're at or where we've been maybe, over the last decade or so, interest rates have been, I wouldn't say zero, but they have felt quite low, like zero. and then they obviously had that jump over the last 2 years, and now the Fed just came out and said, okay, we're going to lower it by 0.5%. So, like for you and where you're at in terms of like looking at where we're at in the economy today, like what are your thoughts around everything right now?
I'm sort of in the camp that regardless of what the Fed does right now, it's really not going to affect the near to mid-term trajectory of employment and the broader macroeconomy as a whole, right? I mean, the economy is a barge; it's not a jet ski,
Right.
and there's a known lag effect to monetary policy, right? I mean, 2.5 years ago, the Fed started raising rates, and only now are we starting to see some deterioration in employment and some macroeconomic indicators. And that is true with all of the past monetary policy tweaks in history. I think markets just have a tendency to be very impatient and to want to see the effect of whatever the catalyst, the cause is right now. And when they don't get that, they freak out, in my opinion. And that's an opportunity, I think, for more patient, kind of longer term investors.
Well,
Go ahead.
and correct me if I'm wrong, but hasn't the Fed's approach to just about all of this to be to talk about stuff and to try and move rates as little as possible and get the market to move just based on how the Fed is positioning or talking about stuff as opposed to actual movement?
There's definitely a lot of kind of job owning that takes place, or rhetoric, particularly as it relates to squashing inflation, right? Long-term inflation expectations are really kind of a psychological phenomenon that takes place, on the supply demand side of, kind of market making within credit and fixed income. Um, Once the long-term inflation expectations are properly anchored, I think that does give the Fed a lot of optionality in terms of what they want to do with the balance sheet, what they want to do with the overnight rate, and trying to get that harmony between, what is the R star or the neutral rate. Nobody really knows. I'm personally of the opinion that it's a lot higher than 2%. I think that the neutral rates, Larry Summers has been kind of screaming this from the mountaintops for a while now, where he thinks the neutral rate's probably closer to 4, which kind of intuitively to me would actually make sense. If we've got policy rates at 5.5, and if our star was truly 2, that would imply that there's 350 basis points kind of tightening. It's overhanging the economy, and we were all bracing, waiting for this crash, macroeconomic deterioration that never really came. It would actually make a lot of sense that maybe our star is 4.25, something like that, where, yeah, we were tight, but we were only tight by 75, 100 basis points or so. And the economy is probably, and inflation in particular, is probably a little bit stronger than the years prior to all of that stimulus and all of that productivity gain post-COVID. So that's sort of the camp that I'm in. Is I at least before this employment number, which was just a couple of days ago, which was kind of a shocker, there were 10 rate cuts priced in, including the 50 basis point cut between then and March of 2026, which would imply that the Fed would bring rates under 3%.
Right.
And I personally don't think that, barring some kind of cataclysmic, very severe disruption, I don't think we're going to get there anytime soon.
When you think about like 4.25 or 3.75 or whatever the star is, are you thinking of that as like an annual number? Is that, do you typically look at like a 3-year number, a 5-year number? What are you looking at when you talk about or think about that?
That's an interesting question. When I generally think about it, I think about it as an annualized number. I mean, if you're gonna boost your horizon out multiple years, I guess you're gonna have to discount that, quite a bit because of how uncertain the future is.
Sure.
I definitely think that long term, the level of indebtedness that corporate balance sheets, household balance sheets, fiscal balance sheets have relative to the demographic trends and productivity trends, I think we're in for a long, sustained kind of low and slow, sluggish period. Similar to what we experienced in 2015 to 2018, I think, where it's not this kind of big deterioration or this big sudden catalyst that sends unemployment to 15% or anything like that. But I think it's going to be really tough to extrapolate the growth and the productivity we've had over the last couple of years after all that stimulus out into the future. I think that tapers off pretty substantially going forward. So maybe if you were to look on like a 5-year kind of target, maybe that does kind of come down a little bit as time goes on and that sort of evolves.
Sure. And almost more of where I was thinking of it is like we had this like big spike in inflation, right? And like we're still hearing whether it's political rhetoric or like heck, Ryan and I are still hearing it from clients of like, wow, stuff got really expensive. And so I'm almost thinking about this like more from a micro standpoint of like, okay, how is this going to affect the next, 2-3 years? Do we take a look at the fact that, yeah, we had these big inflation rates, and it's going to take time for that to have made its way through the system. And like if we had this spike in inflation, and then we've got maybe more like, 2 to 4, whatever the long-term star is, how long is it going to take to get back onto the same trajectory as if we were just drawing a linear line? And does that affect the thought process on fixed income at all?
Yeah, that's an interesting point. So, I would bifurcate the causes of inflation between supply side and demand side, right? Whereas, demand side is fairly sustained, kind of like a long-term rolling wave, if you will. Whereas supply side price volatility can either be here for a long time or it can go by, very, very quickly. Post COVID, we had a ton of supply side inflation as it related to just shutdowns and breaking of supply chains and things like that. And that took time to resolve. And I think for the most part, we've gotten past that. But there's still a certain level of demand side inflation, particularly in the services space, not necessarily in the goods sector at all, but in the services space, that's still running pretty hot. And that's something we're keeping a close eye on. That combined with housing and shelter, which is a major component of CPI. Those two inputs are a pretty big weight within the CPI calculation itself. And those don't seem to be decelerating the way that the goods sectors are. So that's cause for concern. I think, in my opinion, I think it's going to be pretty difficult to get to that 2% target. I don't think we get there. And the thing that really keeps me up at night, honestly, is this scenario that I think is actually pretty plausible, where the Fed cuts 100 basis points between September and March, maybe 150 basis points. And depending on who gets in office, let's not even go down that road. But let's say that some taxes are cut. There's some stimulus in some form or another from a fiscal standpoint, whether it be tax cuts or subsidies or welfare or whatever. Because no matter who wins, that's going to happen. It just depends on the route or the avenue for stimulus. As you have rates coming down, there's a lot of buyers, anecdotally at least, that have been priced out of the housing market. And if mortgage rates do start to come down and the stimulus button is pushed, I could see a situation where housing really, really reaccelerates. And then you get to summer of 2025, and the Fed just cut 150 basis points, and inflation starts to reaccelerate. And the crazy thing about that is exactly what happened in the 70s, right?
Well, I mean, isn't that the self-fulfilling prophecy of the Fed cutting rates? Is that like we've got all this pent-up demand for buyers on the real estate side, whether it's, folks that are trapped in their home or, people that are sitting on a bunch of cash waiting for rates to get to a point where it's whatever reasonable is for buying a home these days. Which down where you are or up where we are, I'm not sure any of it is reasonable. But we can have that conversation a different day. But it feels like, cutting rates like that is just going to accelerate the housing component. And that's what, 30-40% of CPI.
About a third CPI.
So, so if you've got so if you've got somebody pushing a stimulus button, rates dropping, and pent up demand, that's just
seems a little premature, to be calling them, mission accomplished on quelling inflation, in my opinion. There are a lot of really smart people who are arguing that the inflation number is actually far lower than what we're seeing now. And there are a lot of lags as it relates to some of the input data, particularly in housing as CPI is calculated. Nonetheless, there are so many potential catalysts over the next 6 to 12 months, whether it be the election and what fiscal policy looks like, to geopolitical events and supply chain risks. My goodness, I mean, there's political risk in the U.S. as well as in Europe, and all of these variables could really disrupt the status quo in terms of the free flow of trade. Like things like tariffs, obviously. I say all of that because, at least our firm, we don't try to predict the future, right? We just try to build a portfolio that we think is going to be as robust as possible for the various potential scenarios that we could see coming to fruition. There's a deep sense of underwriting and scenario analysis and optimization of scenario analysis. So expected value, for example, right? So a simple example would be, let's just define an upside, a base case scenario, and a downside scenario to a particular investment. What's the probability? The hard part's coming with the probability weights of those scenarios coming to fruition. What are the probabilities? And we'll obviously stack. We'll probably boost the probability of the bad outcome coming to fruition, and discount the bull case, and we'll run the expected value on that scenario. And if the scenario is still positive, the expected value is still positive, then we might move forward, quantitatively speaking, with underwriting that investment. From a portfolio standpoint, we try to use either a parametric return model or a risk factor stress testing model to try to define, okay, what would the world look like if Israel preemptively struck Iran's nuclear facilities, which, we were talking about this 4 months ago, and people were calling me nuts, and now it seems to be unfortunately, a fairly plausible situation.
Yeah.
Same thing with China, Taiwan, right? I mean, you got 90% of the advanced semiconductors for AI and computing coming out of Taiwan. Taiwan Semi, most of that plant, the proprietary technology, is booby-trapped in case of an invasion. Could you imagine what would happen to Apple, Microsoft, NVIDIA, Google if you took 90% of semi-production offline for the foreseeable? There are serious risks. I don't mean to be like this doom and gloom type guy, but there are some pretty, seriously worrying catalysts or potential catalysts on the horizon. And we just try to be thoughtful about that. I'm not saying that's going to happen necessarily, but even if that's a 5% chance, even if it's a 2% chance of happening, that's still an uncomfortable amount of risk given the severity of the situation should that happen. And if we can buy some very inexpensive protection that just cuts that left tail down just a little bit, that's sort of our goal, is to build an income portfolio that kicks off good monthly income, and we'll take about 20% of that income and we'll buy these sort of esoteric, very inexpensive downside hedging protocol.
Sure. And just so that we're not speaking too much technical jargon, sure. By left tail, what you mean is the outsized downside risk, and trying to reduce or eliminate all of the potentially really bad outcomes. Am I paraphrasing that correct?
I'm going to remove all of the risk from a portfolio. It's just
you never can.
Never going to do that. However, the tails that we're talking about is under a distribution or a bell curve. If you put all the scenarios under that curve, the thing that we used to kind of joke about in the analytics group at BlackRock was the world is not a bell curve. It's not a normally shaped distribution. You've got these big fat tails, and then the middle is kind of just squashed down, if you will, most of the time. And all that's to kind of simply say, it's not, or actually, let me rephrase that, right? So people sometimes in like financial media say, oh, that's a three standard deviation event or a 5 standard deviation event, right? And the number of 10 standard deviation events that we've had in the last
shouldn't
15,
exist,
right? Exactly, right? Where theoretically, mathematically, a 10 standard deviation event should happen once every 500,000 years or something like that. And we tend to get these 10 standard deviation events like every 6 months. And so that's kind of like what we're saying is, market pricing generally looks at these types of out of the money events, and market pricing kind of scoffs at it, and they don't really pay any attention to it all. And the protection actually is quite cheap until some headline breaks. All of a sudden, it's in vogue to talk about, and then by then you've kind of missed the boat if you wanted to hedge. And that's sort of what we're trying to look out for, is things that are a little bit off the run, a little bit overlooked, that we think could pop up one day and bite us.
So as we're, just to kind of interject here, because I'm imagining being a listener in a car right now, Alex, and we've gone quite analytic here.
Too far down the rabbit hole.
Well, I love where we've gone from the standpoint of everyone hearing how this is operating. I want to bring this back around. So if I'm a client, my overall question is really going to be, okay, how do I mitigate this risk that we're all talking about right now? And Alex, you and I always talk about, diversification, right? Like you just brought up like the semiconductors and how that affects all these different tech companies, which in theory is a big, this thing called the S&P 500 that a ton of people are invested in, right? And most of the times, most people's portfolio, that's like 40% of their portfolio, not even understanding what that really means. And so what we're talking about diversification here is not just focused in one particular asset class, like a tech company or S&P 500 index, but also bringing this into mitigating what, today's episode is around fixed income or how interest rates are affecting that. What should clients be looking at or doing, if anything, right? And I think that's the overall question. Alex and I would talk about make sure we've got different buckets at play so that not all of our money is affected in such a fashion. But what would you say to that, Joe, in terms of, a normal person managing their portfolio? What should they be doing?
Sure. Yeah. I mean, I talk about this all the time with my folks, my in-laws, some of my friends who aren't in the industry. I think with equity markets near all-time highs and credit spreads near all-time lows, meaning, there's just about perfection kind of priced in here, and the expectations are still pretty rosy. That being said, there are a number of risks on the horizon. I don't think S&P is going to fall 25% or anything like that in the base case. However, I think it's a very prudent time to take a hard look at what your exposures are, and in particular, what maybe your beta is to various market indices. How exposed are you? If said another way, if I was an advisory client, if the S&P did fall by 25% from here, would that materially impact my quality of life? And if so, maybe you take some chips off the table and reevaluate what the exposures that you do have are. We're near the top of a epic bull run in a handful of large cap equities. I'm always sort of the mindset that it's prudent to lock in gains where you have them, and continue to let the dogs ride. Don't sell everything and go live in a bunker. But I think it's a prudent place right now to de-risk the portfolio and look at diversified sources of income. And to be totally frank, I'm talking my book a little bit here. I truly believe the way that we've constructed our strategies and everything like that, I want to make money regardless of what happens to the S&P 500. That's our whole modus operandi. Is the S&P goes up 5, down 5, doesn't make a difference
Well,
to
what's
us.
interesting about that, Joe, what's so funny about your statement there, I'm sure everyone in their car or if they're watching us on YouTube right now also agreed with that statement. They want to be able to make income regardless of what the S&P or stock market does, right? Which is so interesting because, even though you're managing the funds and looking at the picture from that standpoint, this is how you should be managing your finances to begin with, is making sure that we don't have ultra targeted um, asset classes in the portfolio where it could completely derail what you want, what you're building, lifestyle, all that fun stuff.
And to play the devil's advocate there, I think that it's necessary to have some element of market beta exposure in portfolios. I think
Yeah.
you need
That wasn't my statement to not have it. My statement was to make sure that you don't have too much of it. And this is where that diversification part comes back in.
Well,
absolutely. I couldn't
I
agree
mean,
more.
if we're at the end of this massive run, like let's make sure that we're doing things like rebalancing. Let's make sure that like we're doing things where we're trying to reduce or eliminate as much of that tail risk as possible, whether that is using building in some more guarantees or using buffered type structures and solutions, or using portfolios where it's intentional to try and eliminate some of that tail risk. Like these are the types of strategies that make a lot of sense in the environment that we're sitting in right now. And to your point, let's take some of the chips off the table. We want to do that in a proactive, meaningful manner without destroying the ability to have upside inside of the portfolio.
That's very well said. That's the sort of the holy grail, and as far as I'm concerned, within financial markets, is there are some managers, right, that if the S&P is up 10%, they want to be up 20, and I get that. There's a place in the world for those types of managers. I personally, the way that we've constructed our firm, I would much rather capture 70% of the upside and ideally not lose any money at all. Or if we do lose money in a big bear market, it's very minimal. And I can sleep at night knowing that we're well protected and we're covered. And so that's the way that we decide to position our exposures, and ultimately it's up to allocators and advisors to create their own optimization of what the cookie cutter type pieces within the context of the broader portfolio should look like to make the most optimal structure for the clients.
Love it. We could continue this conversation, I know, a lot longer, but I do want to respect, Joe, your time here. Is there anything else that you think we should be talking about, or people should be considering, given where we're at right now, that we should give you time to speak into?
I think maybe just quickly, like the last big dynamic in my mind is just the amount of cash that's been collecting 5.5%, in T-bills for a long time. And as rates come down, assuming that they continue to come down, which is at this point it's an if, but if they continue to come down, I'm very curious where that cash goes. Do you deploy it into the equity market at all-time highs? Do you rotate it into fixed income? Do you rotate it into alternatives, private equity? Because there's a mountain of it out there. And as that gets deployed, that's another catalyst that could potentially reaccelerate inflation in its own right and really kind of create a bull market. That's the risk to the upside, that we're sort of watching pretty closely as well.
Right.
Anyway, yeah, that's probably where I'd leave it.
No, solid point. Alex, anything you got?
I mean, like there's like as I'm sitting here trying to digest all the stuff that Joe's thrown at us, and like this has been awesome, Joe. Thank you. I would like if you're up for it, we'd definitely love to have you back, and if nothing else, just hear some of these like cool stories, like camouflage of Greek pools and various different like that's awesome. That'll stay with me for a long time.
Yeah.
But
Well,
yeah,
thanks.
like
I'm glad you liked it. It stayed with me for a long time. I couldn't believe what I was hearing. I didn't get to go to Athens, but my boss did, and it was hilarious. A Greek official picked him up from the airport on a Vespa and took him to the central bank where they were protesting outside. I mean, it's just a really wild time. But anyway, well, I'd love to come back. It'd be great to chat with you guys more.
Awesome.
cool. Thanks, Joe. Appreciate it.
Yeah,
Yeah,
appreciate you being on, Joe. All right,
thanks.
take care.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7163658.1. Expiration date 10/2026.